The code says leave banking to bankers. We challenge that.
The code says only pros can invest. We challenge that.
The code says banks don't care. We challenge that. We love numbers, but we don't treat anyone like one. We become strong by making our clients stronger. And that's why we challenge the code.
Very good morning to all of our audience members today. My name is Christina Aquino, and I'm the team leader for Bloomberg Markets Live here in Europe. I am currently in London, and I'm welcoming you to day one of the special virtual series titled Navigating Markets 2020. In the next 2 days, we will be speaking with many of the leading names in the brokerage industry and financial markets to understand risks and opportunities brought on by the pandemic, as well as event risks such as the US election, US-China tensions, Brexit, and more. Now, before we begin, I would like to run you through some housekeeping announcements. Firstly, we have partnered with Thyssen, which is an audio-to-text platform transcribing today's discussions in real time. You can access the transcript via the link in the session description. And if you experience any issues with the audio or video quality while viewing, try to refresh your browser or use the chat box in the bottom right corner of your screen for support. We also welcome your questions during our panels. Make sure to submit them into the white box on the right side of your screen, and please include your first name and city when typing them. You can also join the conversation via social media. Follow us on LinkedIn, Twitter, Facebook, and use the hashtag #NavigatingMarkets. I would lastly like to thank Swissquote Bank for their support in making this event possible. Make sure to check out the Swissquote institutional brochure for the notes on thought leadership, which you can download from the agenda tab. Now, I'm very happy to kick off the very first panel today, which I will be hosting. I'll be speaking to two leaders in the brokerage industry to get their take on risks and opportunities in these extraordinary times. COVID-19 has certainly changed the way we work and has thrown markets into turmoil like never before, not to mention all of this year's big events, the yet to be concluded US election, as well as Brexit among them. How are these businesses thinking about the future, and how could these events change markets in the financial industry as we know it? So I'd like to introduce you to today's esteemed guests. Firstly, we have Mark Berkey, who is the CEO of Swissquote Bank. A very welcome to you, Mark.
Thank you.
And we also have Dennis Dijkstra, who is the Chief Executive Officer of Flow Traders. Welcome, Dennis.
Good morning. How are you doing?
We're very, very well. All right. Well, we have a lot of discussion points to get through. It's been a very busy week for markets, as you both probably know. So let's get right down to it. My first question is actually reflecting a little bit on this year. Mark, let me put this question to you first, and I'll give Dennis an opportunity to answer. So, Mark, if you could describe business this year in one word, what would it be and why?
Oh, in one word, I would say crazy. For many different reasons, but it was a crazy year so far, and it's not finished.
Okay, and it's not finished. That's right. What about you, Dennis? What is your one-word description of business this year?
Yeah, so I had kind of the same crazy, but I would say epic, because it has been
Epic.
kind of epic. So it has been really, really intense, but for kind of liquidity providers like ourselves, it has been also a moment of truth, right? So these are the circumstances where we can really show what we're good at, add liquidity to the markets, and also kind of the results were really, really good. So yeah, and I think the whole system held up really well. So it's been kind of a nice but really, really epic and intense period.
All right, tell me a little bit more about this epic year, Dennis. What were some of the challenges that you faced this year, and how did you as a business overcome them?
Yeah, so we run a global business. So very early in the year, we saw what was going on in Asia, and that it would kind of hit Europe and later the US as well. So we could prepare ourselves. We are a agile company, so we're getting the operations prepared for the market circumstances in kind of March and April. And then dealing with the business. So keep the business going, but also making tough decisions, right? Who needs to work from home? How are we safeguarding the health of our people? And those are difficult decisions. So it's kind of a very intense time running in operations and managing a lot of people globally, right? So we're a global business. Also there, it's kind of you have to talk to all the offices, all the other people running the offices, but also keeping the focus on the long term, right? So we're not here just in the current markets. We also have a strategic plan on diversifying, growing our platform. So also there, making sure that everybody who's working from home keeps connected to the company. We're all focusing team on executing our growth plan. But and it's tough. Also there, having everybody connected to the company, feeling part of it. It's a challenge, but we're doing very good so far. But it's very intense and exhausting as well. So,
Okay. Well, Mark,
tune in
let
last
me ask
year,
you.
too good to know.
Well, Mark, let me ask you, why crazy? What were the events this year that particularly made business crazy for you?
Well, I think markets certainly were completely crazy again. You know, when you think that you can have these massive swings of 2-digit numbers on big indices, and that you had crude oil that would turn negative, and all those things actually never really someone would have been crazy enough to forecast such a behavior of the market. So it was crazy in that sense. But I think also it was a great year for online banks because technology was on our side during the pandemic, and this also explains why online banks had this massive inflow of new clients, simply because their business model was actually made for a home office situation. We had lots of new clients joining our banks. And some of them simply because during this pandemic, during the moment where all the traditional service banks were at home, nobody could reach their advisors. So suddenly they say, well, I'm already sitting on my computer doing home office. Why shouldn't I switch to a bank that is specialized in those type of technologies? So it was crazy in that sense, because we have been overwhelmed by account openings during these 2-3 months where everyone was working at home, and now we have the feeling that we are going a little bit in the same territories again. So at least here in Switzerland, it's a semi-lockdown, so people are going back home, and we experience again the same type of inflow of new clients.
Very interesting. Now, Dennis, I think Mark touches on some of very important points that you and I have spoken about, this trend of digitization, right? And being or businesses having to get used to the idea of conducting business and servicing clients online. Do you think that, you're part of the financial industry, in particular, the brokerage industry, is more suited to this than perhaps others, just because by nature, it has, even before the pandemic, been a mostly online-based, digitized sort of industry?
Yeah, so it's also there the kind of the beginning of the year has kind of helped kind of accelerate some of the kind of the challenges. So also there, I think the automation of a lot of the workflows. I think that has just been favorable for all market participants. Whereas still, if you think about the stuff that didn't go well, that's still a lot of the manual things. And it also focuses on kind of with the digitalization automation, you can embed a big part of your risk management framework in your operations and systems. So also there, the firms who have their automation, digitalization kind of in order, they will benefit. So it's kind of a acceleration in maturing of parts of the financial markets, where I really hope that will continue. Think about fixed income trading, or kind of the whole OTC markets, or kind of some of the spot trading and precious metals, where we kind of really gained a lot of market share, where other market participants kind of were struggling a bit. So also they're thinking well ahead, having your risk management in order, and having invested, because also there have firms that kind of like ourselves who have been investing in automation, having the ability to deal with kind of a thousandfold of trading. Those are the winners.
All right. And Mark, on the client side, you had some very interesting insights about just the influx of new clients this year. What were some of the interesting observations that you've made, either in terms of your customer base and how that's changed this year versus previous years, or maybe even demographics or the sort of assets that they prefer?
Mm-hmm. Well, we traditionally had younger clients, so the average age of our clients would be around 40, 42, and then we have the so-called silver surfers. I'm almost part of that of that category.
No, no way.
These are people that let's say older than 60, and in between, there's some kind of clients that were resisting a little bit to the business model. Now, what is very interesting with those clients, they have higher assets. They have been maybe with private banks in Switzerland, and they suddenly started to flow into our banks. So what I've seen in the period, and what was very interesting for us, is suddenly you have clients in the 50s. They bring more assets, so they are also have the capability of ultimately bringing more revenue to the system, and it's a challenge for online banks, because of course, when you bring more assets, when you come from a more traditional bank, private banks, then you expect to have higher services, and so you also have to organize your company so that you can serve those clients. And this is a little bit what we did in the first half of this year.
Okay, yeah. And what was it about the environment this year, you think, that brought on a lot of these kind of new types of clients? Is it just they had not much else to do? They were sitting bored at home in lockdown, and they were thinking, might as well start trading?
Well, I think the markets made the news almost every day. You could remember. It seems so far away already, but we had the VIX up to hundreds. You had these incredible market swings in one session. You had this unbelievable recovery from the low sessions during February. So all these actually attracted clients who say, well, there's maybe a good opportunity to also benefit from that market movements, and these movements have been seen not only on the equity side, but also on all kind of currency, in the forex, in the commodities, even on cryptocurrencies. You had these incredible moves there. So this really motivated people to say, well, there's potentially some good money to make in that period of time. But I think more importantly, they realized that managing your wealth is not necessarily something that you should completely outsource to a third person. You have to stay in control, because when it really hurts, when really you have to act, then you should be able to press yourself on the button.
Okay. Now, both of you are veterans of the 2008 crisis. Dennis, I know that you started at Flow in 2008, at the end of 2008. So, and there have been a lot of parallels and comparisons made from that time to this year's crisis. But how do you think it's different, and how do you think it's similar, Dennis?
Yeah, so I was talking about what few of the guys here on the dealing room as well who've been around for a bit longer. So it does feel that 2008 was even worse, because I think then there was more of a kind of a questions or doubts about the system altogether in general. Whereas now it was more focused on the economic impact. So from our perspective, or I would say that kind of 2008 was probably a bit more. There was less liquidity, so I think the markets functioned different. So the markets in March and April functioned really well. I think also there, a part of the regulation, the transparency, probably even better capitalization of a few firms have really helped. So that although the markets were kind of as volatile, I think the being in the market, it was slightly different. Because I think it was more about the confidence, who you trade with. There, a lot of the trading is more centralized now. There's a lot more transparency. So that really, really helped. Also, the products are slightly different. There's a better view on who you're trading with, what the credit risks are you're running. So that has helped a lot. But there were a few moments in March where also there, I think there was almost a run for liquidity, right? So also there, then just everybody's kind of selling everything because they just want to generate dollars or kind of cash. So I think it was close, but I think 08 was probably worse, because I really do think that the markets functioned really well in March and April. So there were no big outages. They were volatile, but everybody still could trade. And I'm interested to hear Mark's perspective there as well, because he's kind of facilitating a different side of the market.
Yeah, what about your perspective then, Mark? 08 versus today, what's different?
Yeah, well, I just to the last point, I agree. I mean, I can remember that we had discussions whether we should suspend market. That was at least in Switzerland. It was a discussion whether the Swiss market should be suspended for a period of time. But this was really not necessary, because even though you have these massive swings, but everything went smooth. The markets did function. There was a liquidity squeeze, absolutely. That was the case, and these also triggered this massive sell-off. But I think what was different between this year and 2008 is certainly the economic background. In 2008, it was more of a systemic nature of the crisis. This sovereign debt crisis all over the world, and this time the feeling is that it is not fundamental. It's really linked to this pandemic, and we could imagine that as soon as the pandemic is gone, then everything goes back to normal in a way, and then we go back into growth territory. Now, at least this was the feeling back when we are hit by the first wave. Now, of course, the question is, as longer as the second wave does last, the question is whether it will have some long-lasting effect on the situation, and that finally the world will take several months and years to recover from this drop. There's a little bit the fear currently is that it has to stop, and it will certainly stop whenever we have a vaccine that will be available to the market, so that we can reduce the number of infections. So I'm a little bit less positive. I would like to say I was very positive back in summer when it was looking good and everything went back to normal. But now here in Europe, continental Europe, we have been hit quite hard by this second wave, and the long-lasting effect on the economy could now trigger in.
Well, that leads me very nicely to my next question, actually, which was just taking a look at some of the trends that emerged this year, whether it's regarding markets or the economy or the business itself. Of those, what do you think would be the ones that last into next year and probably in the next few years? I mean, Mark, you're quite pessimistic. Why is that? What do you think is what is a negative factor that might persist beyond this year and into next year?
Yeah, I may start with a positive one, which is the domination of digital companies. When you see the weight they have now in indices, the GAFAs, they just made the biggest part of the indices, and this is just amazing how much we have entered into the real digital age now. We have been forced to do so because of the pandemic. So I'm very optimistic about digital companies. So I think that they will push further the the indices. I'm a little bit more pessimistic about, let's say, more traditional companies, like the airline industry, not to mention, but also maybe traditional car makers.
Okay. And Dennis, what do you think? Do you agree with Mark on these points?
Yeah, I definitely do. I think, as said, it has this year has accelerated a lot of trends which were already happening. So digitalization, a transition into a more kind of information or tech-driven economies. Although I do, so I'm not per se pessimistic or optimistic. I run a business. I need to make sure that we are prepared for the future, that we're probably even a big part of it. So that's where I focus on it, to make sure that we kind of focus on the right things. I do worry, and that's the bigger theme, is that everybody is included. So also there, the transition for everybody to be included and be part of it and be comfortable with the change, because it is a big change and it's very kind of intangible. People kind of have difficulties adjusting. So I think that's where still a lot of work needs to be done, and also kind of who is benefiting from this big change, and because also there this is almost dividing big nations of people who are kind of part of it or benefiting from it and are kind of scared for their jobs, because I think also there the acceleration will put a lot of kind of more traditional jobs at risk. So also there, I think that's kind of more of a unrestness in society, which is kind of we're kind of making happen. And I think that's where we really should focus on making everybody part of it and comfortable with the change, because everybody should benefit, because it's more efficient, because it will bring down the cost, but also the working from home. So it's companies are more comfortable that employees could work from home and add value. Yes, also there, I think it's a big opportunity, but we should make it kind of in the society a bit broader, I guess.
Well, that actually leads us very nicely to this question from the audience. It's all about the idea of equity and wealth distribution. So one of our audience members is asking, what can we do to have wider equity ownership in crazy times? This is your term, Mark, whether you're rich or poor. Very interesting question. What do you think, Mark?
I'm not sure whether I do understand the question. So what do you think he means by wider equity owners? You mean
I suppose I would interpret the question as probably a little bit about access, whether you're a very wealthy investor, or maybe you're not so wealthy and you're just starting out. How do we kind of improve the distribution of equity ownership?
Oh, okay. Well, I think it's the service level. It's you have two things. On one side, you have this crazy digitalization. So it's really a revolution in the sector, and it's not finished yet. And then suddenly you see completely new actors emerging out of nowhere. Just think about Revolut or those neobanks that have emerged and that are taking a big part of the market in a very specific field. So to get a bigger part of equity ownerships and owners as online banks, you just have to improve and increase your service levels. Come from very specialized field into a broader range of services. In our field, it also means that we need to have an opinion about the market, which is something new. For now, each time we had the clients telling us, should I buy or sell, or what should I do? I say, well, we have no idea. We just execute the transaction nicely, but it's your decision at the end. And now this we can't do anymore. Now they want us to have an opinion, a qualified opinion, and this also means that behind that you need to construct your business in that way, because as a bank, whenever you have an opinion, it has to be qualified by something. And our regulator in Switzerland is very eager that we are very keen on that part of the business.
Okay, so Dennis, what are your thoughts? Oh, sorry. Yes. Are you finished,
Oh
Mark?
yeah.
Sorry.
Yeah.
Okay.
Oh, okay. Yeah.
What about you, Dennis? Yeah.
No, so this is about making it equity ownership also available for everybody. Right? So also there, I think digitalization or makes it happen. So also there, there is no difference between rich or poor because it's available for everybody. Everybody can open a securities account at Swissquote or any other kind of broker and trade very efficiently. So I think also there, digitalization is opening up a lot of markets very efficiently and cost effective for everybody. Also there, I think that's the benefit from our business models. We don't discriminate on age or even net worth because I think we do want to make it available for everybody. That's kind of it's already there. I would say, and I always make fun of my father-in-law. He's probably he's already retired. He should embrace it, and he should trust also the new opportunities that are there. That he can invest his portfolio very efficiently in different products than he's used to. He can do it himself very efficiently, cost effective. If you do that for 30 years, you will have a better pension than I don't know 50 years ago.
Maybe he can be one of the silver surfers, opening an account at Swissquote.
Yeah.
Sure.
All right. Well, we're just about out of time, but I do have one last question for each of you, and that is, what is the one thing that keeps you up at night? Mark, let's start with you.
I think IT threats. We're so much dependent now on this digital infrastructure, and we've seen it. Working from home. Why did it work in 2020? And luckily, the pandemic happens this year and not 10 years ago, because in the meantime we are digitally organized. The infrastructure is there. So what keeps me up at night is to think that there could be a major threat on that infrastructure, whether it's an attack or just a complete breakdown of the system because it's used by too many people.
Okay. And Dennis, what about you?
Yeah, so for me, it's kind of keeping up with all the transformations and changes in the world, especially as the chief executive of a young and scale up, which we still pretend to be. It's a tough job to kind of keep on with all the changes and making sure that everybody's kind of supporting it, but also not overdoing it. I think that's as the chief executive, something that keeps me thinking.
Okay. Well, thank you very much, gentlemen. That about wraps it up for us. And it was very great conversation to have with both of you. Thank you for your insights. Now, make sure to our audience members to stay on for the next panel. That's going to be all about how the global health crisis is changing investors' perspectives, particularly regarding American exceptionalism. Bloomberg Television Markets reporter Danny Berger has a great lineup of guests for you. So I'll give it over to you, Danny.
Thanks so much, Christine. Hello and welcome, everybody. Very excited for this panel. We have a lot of big picture topics to cover. We're going to focus on COVID-19, the U.S. election, but really all of that in the context to the threat of American exceptionalism. What do these developments mean for America's historic market dominance? Do we need to reimagine that market? And obviously, the election is top of focus for a lot of people right now. As the polls stand, or as the results stand so far, it does look like Biden has a clear path to the presidency, though Trump has announced his intentions and is filing lawsuits with a few states regarding the vote count. So there is certainly some time to go before we know the final outcome of the U.S. election. Joining us today, we have a really expert panel with us. We have Peter Rosenstretch, who's head of market strategy at Swissquote Bank. We also have Tina Fordham, partner and head of global political strategy at Avonhurst, and Karen Ward, chief market strategist EMEA at JP Morgan Asset Management. I think part of one of the ways that makes perhaps the most sense to sort of kick off this conversation, Karen, I want to start with you and just define for our audience what is American exceptionalism.
It's a good question, Danny. Well, I mean, to me, American exceptionalism is the outperformance that we've seen of American asset classes. And here I'm talking about the outperformance seen by the stock market, the strength of the dollar, and many other assets underneath that. I think if we think about what caused it, there are a few factors. So one is the macro, the outperformance of the US economy, particularly in recent years, which I think is really due to the shift when President Trump took office in 2016 towards much more expansive fiscal policy. That really helped fuel the growth that we saw in America. And then in turn, that delivered a backdrop for the Federal Reserve to normalize interest rates, which of course other parts of the developed world just didn't get round to doing. Their economies weren't strong enough. So that macro backdrop provided you with a yield differential between the US and the rest of the world. And I think that's a big component of why the dollar was so strong. But there are some other macro factors that I think are worth mentioning. One is the composition of the US market. We know this decade, and particularly this year, has been about tech and it's been about growth stocks. And the US market is much more heavily dominated by what has been those strongly favored segments of the global market. So that's the micro factor. And then the final thing is political, which we're going to get onto. I think under President Trump, we had all of these uncertainties about US foreign policy, and that basically gave you a risk premium on international assets. So it's macro, it's micro in the sectors, and it's political as well. So I'm sure we'll talk about whether that's now all changing.
Yeah, you've teed that up absolutely perfectly, Karen. And so yeah, let's turn to the political, and I think especially in terms of the election, Tina, policy, politics, you're an expert in all of this. So I would really love for you to set the scenes in terms of where it looks like the election is heading. Does the possibility of a perhaps messy transition threaten this story that Karen is talking about, this story of American exceptionalism in the investing world?
Thank you very much. Well, in fact, in political science, American exceptionalism means something completely different. It's a historic term talking about American democracy and the extent to which America was set out as a kind of a beacon for the world. So when I think of American exceptionalism, it's really about American institutions, the rule of law, and the conduct of our democracy. Now, as an American living in the UK for 20 years, you get a different perspective being outside of your own country, and the picture that we get is a nation in chaos. I attended an event in London where somebody actually said, "Why are Americans so divided?" And I thought, have you been sleeping through Brexit? So let me put what's happening in the US within American and global context in terms of elections. And a lot of my research has been on, in fact, democratic transitions. And I've written about how this could be America's EM election. Having said that, I think it's time for us all to really calm down and to accept that actually most of what we're witnessing was expected, was forecast. We knew that we were going to be getting massive turnout, historically high turnout. And at the same time, there's a deluge of articles talking about the death of democracy. Well, judging by the sheer numbers of people who turned up and waited hours to vote, as well as those who voted by post, Americans have been extremely engaged in this election, and democracy is not dead. So first point, very, very much galvanized electorate. Second, pollsters have taken a pasting. This is the second election where many of the trends have been incorrect, but we do seem to be on track for what was the base case for pollsters, and that is a huge turnout result rather for Joe Biden in the national vote. He now has achieved more votes than any presidential candidate in history. So greater than Hillary Clinton. This is not a candidate who did not appeal. Quite the contrary. And he is on track to win the Electoral College and to be the next president. We were expecting this trend as well. What perhaps got lost in translation was, as a result of the mechanics of the US process, we saw massive swings. Lots of people I know claiming to have many bottles of wine or vodka and orange juice at breakfast or whatever it might be, a cliffhanger like Dallas, who shot JR. But really, the Trump votes in person came in first, followed by the absentee and the mail-in ballots, and that's what accounted for the swing. Even the delays that we're looking at, and I think we might have a result tonight from Arizona and Nevada, which are still counting, which probably put Biden on the path to victory, is shorter than many of us expected. So markets then turn their anxieties to a contested result and to various permutations, a contested result, and of course we have President Trump being quite vocal about challenging these results. But here's what's really important, right? If in markets we need to differentiate between the signal and the noise, I think we have to add a new category, which is the crazy. Lots of things are being said, but look at how Republican lawmakers have lined up very clearly around the statement that all votes must be counted, right? There hasn't been support from prominent Republican voices lending credence to what the president is talking about. So although this is a noisy election and, full of crazy, and a significant proportion of Americans might be, living in a parallel universe when it comes to news and information flow with the rise of QAnon, for example. In fact, I think in context, things are going relatively smoothly, and I'm sure we'll hear from the next panelist. Where I sit, this is a pretty good result for markets if it indeed transpires that you have Joe Biden as president, Republicans hold the Senate, and Democrats keep the House.
Well, there certainly seems to be some element, and that's how the markets have reacted so far. I mean, we saw this huge rally in the Nasdaq 100, for example. Peter, you are another American based in Europe. I know you get a lot of questions constantly about the U.S. election. But break it down to us how it looks from your angle, from that market's angle as well, that Tina mentioned, between the signal, the noise, and the crazy. How does this election so far impact the attractiveness of American investments?
Well, I think so far the market's taking it relatively well. Obviously, we saw a big move in equities, when Biden was going to win, and it basically looks like, despite the litigation that Trump is planning, that for the most part the election has gone relatively smoothly and was anticipated to have some volatility, but nothing major, and that's what's already priced in. I think when we go back to American exceptionalism, when you talk about an international level, you talk about how the U.S. engages with the rest of the world, and therefore should U.S. assets receive a premium? And for the most time prior to Trump, the answer was yes, that somehow American assets were sort of better than international or EM assets, and therefore should get a higher premium and be more attractive in a global setting. And this will sort of come off or sort of worn down. Now, the investors have continued to flood to the U.S., but the perception that only U.S. assets are good has worn down under Trump. And the question in my mind is, which candidate can restore that bit of exceptionalism in the view of the international investor? And I think Biden can really move forward quickly, by re-engaging in the global markets, with the Paris Climate Accord, UNESCO Heritage Site, UN Human Rights Council, by sort of stepping forward and saying, listen, I'm going to patch up those relationships that will go very far in sort of restoring the global market's faith in U.S. assets. Biden really hasn't provided an enormous amount of clarity, but we know he has a long history as a foreign policy specialist. And I think he's going to make the diplomacy, going back to the State Department, rebuilding that, reconnecting with allies that are sort of worried about Trump's unpredictability. And he's going to do that relatively quickly. And that will, again, give a premium to the U.S. assets.
Karen, I want to bring you into this because when you talked about American exceptionalism, part of it was that during Trump's presidency, we have seen a lot of interest in U.S. assets. Peter is more or less describing a world where, we going back to something normal before Trump. It sounds like you might see that a different way.
Yes, I think so. I mean, I'll go back to my my three-prong framework. The macro, micro sectors, and the political risk premium of the US relative to the rest of the world. I think that the concern I have from the election result, when we think about the economy and for markets, is for me that obviously the surprise is that this is now a divided Congress that's coming out of this. It has not been a sweep in either direction. And the concern I have is that, COVID is still very much prevalent. Indeed, the US is on a very nasty third wave, as far as we can see. And that needs decisive action, both with regards to what is done to tackle the spread of infection, but most importantly, what is the stimulus that is going to be put in place to support the economy in the interim. And my concern is, much like we've seen for the last 2 months, we see this wrangling about the size, the nature, and the timing of that stimulus. And I just don't think we have that time. So that is my big concern. So on that relative basis, on the macro story, I think the US may have less fiscal stimulus versus the rest of the world. The stimulus is coming through in Europe thick and fast. So maybe the relative performance, and as I said, that then leads into relative interest rates. And I think this is where the currency then follows through. The fiscal policy is less in favor of US exceptionalism. I think as we have, I agree with Tina, it's looking like, although it is still too close, we're still emphasizing uncertainty, but it is looking like Biden will take the presidency. And although he's still been talking about some areas which he wants to approach with regards to China, we're looking at that being done via a multilateral framework. And that is in turn, therefore, more predictable. So that's where I slightly disagree with Peter. My view is that the relative risk premia was higher in the last 4 years on international assets because you weren't sure what tweet you could be waking up to and how that would affect foreign policy and appetite for international assets. So that is the other area of, where I think we could see a more level playing field between international assets and the US. The one thing of American exceptionalism that still really holds, however, is that micro sectoral story. It is still the case that the US has those tech, fast-growing tech giants, and I don't think this disrupts the story. I think this is a secular trend, and that's one area which is going to remain very attractive to global investors. So I said there were 3 aspects of the story. 2 have leveled out to me in favor of a more even playing field internationally, but the US still has one aspect of the story.
It's interesting, Karen, because yes, Tina,
Sorry.
Please do.
I actually have a bit of a more nuanced take, I think, because you've seen some comments coming from the Republican leadership that I think are important when it comes to at least the timing of the stimulus. Obviously, negotiations broke down. The extent of what it looks like, the mandate that Joe Biden will have, and remember that we're still looking at exactly the same divided Congress as we had before, so that's not really new, a few seats changing. I think we're more likely to get a stimulus agreed in the lame duck session, i.e. between now and January, as a bit of a concession. We saw statements from Mitch McConnell, who won re-election safely. There are some reasons to be optimistic about how the Congress might work with the president, if indeed it is President Biden. I think this has been, in many ways, difficult period for Republican lawmakers as well, given the kind of high stakes. So I think a smaller, sooner stimulus is something that markets can look forward to. And although when it comes to China trade, although the incoming president, if it is Biden, will have to keep up the rhetoric and the pressure on China, I think in terms of the market's perception of volatility, that is likely to calm down quite a bit.
Peter, if what Tina says, that it does calm down quite a bit, what do you see as the market reaction there in terms of perhaps substance, somewhat the same, rhetoric is different? What happens?
Yeah, no, I think the market will see, or we already saw a massive drop in the VIX, a measure of equity volatility, just yesterday. So I believe that anticipation for one of these large stimulus packages will definitely come down and calm the market. For the last 15 some odd years, the market's been coasting on stimulus. And this is what's really sort of driving. It hasn't been sort of real growth. It's more the fact of sort of central bank and government stimulus that's really pushing things forward. So, getting another injection, whether it's $2 or $4 trillion from the US, will clearly be seen as a positive and help equities continue to rally higher.
What about this? And perhaps now is a good time to sort of turn to the COVID response. In terms of a relative response of the US, be it stimulus, be it just terms of policy of controlling the spread itself. Karen, how do you look, how does this affect the US's attractiveness as a place to invest versus the rest of the world and versus other policy?
Well, I think what the market has demonstrated is it's focused much more on the stimulus than what's happening with regards to the virus itself. So the market's demonstrated time and time again this year that if the virus is on its exponential path, it's willing to look through that. And in fact, even to the point where it's seen to be good news for the market, on the assumption and expectation that you're going to get forceful stimulus to not only absorb the loss, but perhaps intervene directly in risk markets themselves. And that's where you get that sort of double whammy effect. So that is, again, where my concerns come down entirely to the size and the timing of the stimulus. I mean, yeah, I agree with what Tina said. That was a really useful caveat to what I said. There's going to be something that comes through, and it can maybe even in the lame duck session. But, we're talking about 500 billion relative to the idea when we were 2-3 weeks ago and the market was looking for a blue wave of something in the region of a 4 trillion stimulus package in 2021. So the magnitude is entirely different. The way in which it's directed could be entirely different. And that is really where my concerns. I'm worried about the trajectory of the virus in most parts of the developed world. It seems to be on the exponential path in most places. Whether governments put in place restrictions, obviously at the moment we're seeing more in Europe than we are elsewhere, but actually there's a lot of evidence that shows now that whether governments are acting or not doesn't really matter. It's not the key factor, because if governments don't tell you to stay at home, if it's rampant, people stay at home anyway. So it's the stimulus that matters, and I still have my concerns about whether the package that comes through for this wave in the US is going to be anywhere near the magnitude that we saw in the spring.
Tina, should investors be more worried about not just the stimulus, but how policy in terms of containing the virus is handled in the US relative to the rest of the world?
Well, I think that's going to end up being one of the more interesting but slower to develop stories about the message from this election, actually. Just before we move on to the kind of political implications, I would say that it seems to me that another positive outcome for investors about this result is that the Fed put holds, right? So there is that in addition to the stimulus point. It does seem clear that the White House and Congress have been very reluctant, almost given up on fighting the virus, waiting for a cure, waiting for a vaccine. And when I talked about the message from the electorate, the fact that President Trump has managed to get so many votes despite the COVID deaths, despite the economic downturn, and the other hardships, I think is partly a message that Americans are sick of talking about the virus. They're sick of looking at masks. And that should be alarming for investors, actually, because the measures to curtail as we go into a lockdown here in the UK have been unpopular. Americans want to go back to work, and I think they are a bit, well, in political science, we'd say there's less social cohesion. Maybe in plain English, we'd say a bit more callous.
Sorry, Peter, go ahead.
Can I jump in there real quick? I think Absolutely. One thing we need to sort of put into place is that for the last year or so, COVID has become basically a tool of the Democratic Party to unseat Donald Trump. No matter what Donald Trump did before, for the 3 years, nothing could lower his popularity or gain sort of votes for the Democrats. It wasn't until COVID came around where we truly saw Donald Trump's Achilles heel. And we have to say that you don't want to say that Republicans or Democrats politicized the pandemic, but that's truly what they did. So I suspect that if Biden wins and the Electoral College votes and everything is wrapped up nicely for the Democrats, that we're going to change. We're going to hear a very different story coming out. And that optimism, that change of tone will be quick and it will be dramatic. And I think the markets will react extremely positively when that comes around. And I think that people have to realize that a lot of this COVID, especially in the U.S., was a true political tool. Without getting too outside the sort of standard curve, I do believe the tone changed dramatically.
You don't think the pandemic is real?
No, it's not that. It's people's reaction and how they handle it. I believe very. Come on, let's not say that I don't think it's real. I think that was a little of a low shot. But what I'm saying is society's addressing the pandemic. It doesn't have to be so alarmist. We can wear masks, we can social distance, we can change our lifestyle without sort of the extreme rhetoric that's been put around. And I think what we're going to see from, after the election cycle slows down is that America is getting on top of the pandemic, whether it is the use of, all of these tools, if it is the incoming sort of vaccination. And that sentiment will be very positive.
So I think one good way to maybe frame this and sort of, get away from, in terms of whether it's has it been politicized or whatever, is to maybe perhaps compare it to other countries that have handled coronavirus very well. And you look to Asia, for example. Karen, when you look at that picture, you look at cases contained very well in places like China, for example. Do you see any emergence of China becoming a more interesting place to invest, that the recovery story is much more compelling and sort of is one that dominates that of the US's economic story?
Yes, Danny, I mean, like most things, I think this year has just compounded a secular trend. So if you'd have asked me that question this time last year, I would have said, yes, that's where we should increasingly be focusing our interest for investment opportunities. But I think the handling and the performance this year has just exacerbated that. I mean, it's been fascinating. How have parts of Asia seemingly come out the other side? I've been speaking a lot to my numerous colleagues in the region, and I believe it's largely down to two things. One, experience of SARS and the hygiene factors, the masks, basic hygiene practices go a long way, and they're very experienced in that, giving their former experience of SARS. The other thing, though, that is just entirely different is their testing tracing systems. I mean, my colleagues telling me about having their own personal QR codes. If they want to go to a different district, into a shop, into a restaurant, they've got to demonstrate who they are and where they've come from. And of course, therefore, your ability to understand where there's a problem area and then contain it is completely different to what we've got here in the West. So I think they are sustainably out the other side because, of course, they're all then defending their external border. And therefore, that provides a cyclical opportunity. I mean, China is the one part of the world where not only is it back to the pre-crisis level of activity, it's back onto the pre-crisis trend. That's phenomenal. That nowhere else in the developed world is looking like that. But as I say, for us, it was always about the secular opportunities, and therefore using any of this noise and volatility to get into those secular opportunities at better prices. And that's things like the rising middle classes, some of the technological advancement that's happening there. So absolutely, I think when we're sick of the noise and the emotions, as even it is perhaps coming through in this panel, there's a good place to go and take a deep breath and find some opportunities.
So we are running short on time here, but Tina, I would love if you could just sort of leave us on a look forward. We've had this election, which, as you've mentioned, there's been a lot of noise. We've had the COVID response. In terms of America's path forward, in the political sense, in the policy sense, is it a bright one? Is it one of sustaining exceptionalism, be it the policy version, the political version, or the markets version? Is that going to continue, do you see?
Well, as a political scientist, I guess I'm a little bit uncomfortable with that question because to me it implies some kind of supremacy, which I don't think the U.S. has really deserves in the present moment, even though I've argued for the fact that the machinery of U.S. democracy, as well as institutions and the outlook for rule of law, I think is quite positive. I mean, as we get a result in this U.S. election, markets are going to turn back to the state of fighting the pandemic, the trends that Karen has just talked about, which regions and countries seem to be doing well with it. And I think where I can contribute to this debate is some of the softer factors that drive that. If you kind of try to map which democracies have done well in fighting the virus, they tend to have some other factors going for them that the UK and US, with their sort of libertarian tendencies and lower spending per capita on social safety nets, just don't have. Among these are higher levels of trust in government, that social cohesion factor that I mentioned. The point about a previous experience with a pandemic is very important. We've actually seen in Africa that they've managed to fight the pandemic quite well because of Ebola and other existing infrastructure. I think some of the lessons from this U.S. election, as well as the other themes we've touched upon, are going to be continued strong demand for government intervention, whether it's government on the left or the right, changes in the social contract, that means more stimulus, continuation of very active central banks, and the countries that will do well will have to invest in that technology, the test and trace, and allow that data to be collected. If I think about what I'm worried about next in America, it's that survey data suggests that as much as 50% of the US public wouldn't take a vaccine if it were available. That's the kind of indicator which to me is very alarming.
Right. Well, it looks like we've run out of time, but just really, really quickly to wrap it up, 15 seconds for both Peter and Karen. What's the region you would recommend people to invest in? Is it the US? Is it Asia? Is it Europe? Or is it Peter? How about you first?
Yeah, no, I believe with Karen, I think Asia, especially China, it has accelerated its sort of economic standing globally during the Trump administration and now during COVID. And I think it will continue to do well. And I think it's poised to have a remarkable few years.
Karen?
I'll just add that I think increasingly we should start thinking about India, because I think given the different demographics, within 5 years, we'll be talking about India today in the way that we currently talk about China.
Very interesting. Well, thank you so much, Peter, Karantina. This has really been fascinating. I feel like we could probably carry on this conversation another hour longer. But the good news for everybody listening, you can continue the conversation on social media. You can follow at Bloomberg Live on Twitter or LinkedIn. We also have the hashtag navigating markets. You can continue the conversation from today and network with other attendees in the event community. That you can access by clicking on the community button on the navigation bar. Want to remind everyone, definitely stay tuned for day 2 sessions in London. That's going to be at 11 a.m. local time. The focus then will be on the future of asset allocation and how investors and traders could navigate and tackle this economic calamity. So again, I want to say thank you to my panelists and to really all of our speakers, Christine's panel as well. Thank you so much for joining us today. We're really very, very grateful for your participation. Also want to give a thanks to our sponsor, Swiss Quote Bank, as well, for helping us make today's virtual event possible. And a big thank you to our audience as well for joining us today.